Hi, I'm Stacey from Fun Caliber, and this is part 2 of our Valentine's Day special. In our first video, we discovered which investments had 6 managers looking for love, and in this video, we're finding out the area of the market has our managers saying, "Thank you, next." Government bonds are at the top of the list for many. Gary Potter, co-manager of BMO Navigator Distribution, explained it best.
But an area that I think generally that I'm struggling to understand across the piece is bonds. Because, quite frankly, when you think about what the investors in our funds want, they generally want us to make the money over a reasonable time frame, beat inflation, and cover the cost of advice. And if I look at the paltry returns that are being offered on government bond markets, particularly, they don't cover inflation, they don't cover the cost of advice, and if you hold them to redemption, they're going to lose your money.
Of course, as Richard Parfit, co-manager of VT Seneca Diversified Income Fund, pointed out, some funds are mandated to hold a certain amount of fixed income, so it's about finding the best options available. Matthew Stainsbury's co-manager of Close Managed Income agreed.
Yeah, so we don't particularly like government bonds, very low yield, a lot of duration risk, potential for interest rates to rise, but we do still own them because they do provide a very good hedge for tough times. So yeah, underweight, have been for a while, don't like them, but do still own them.
While bonds seem universally unloved, the next 2 areas these managers are avoiding might shock you. Let's start with David Coombs, manager of Rathbone Strategic Growth Portfolio.
So with the possibility of really upsetting my children, social media. I think social media is definitely an area that people will want to avoid. I think we are in for, I think we've hit peak social media. Yeah. As has happened with Donald, for example. I do think that the Facebooks, the Twitters, and all these other companies are going to come under threat from regulation, from people wanting their privacy back, and people more concerned about their digital footprints. So that doesn't mean all will lose, but I think it's going to be an area coming under greater scrutiny. And these companies are not tech companies. In many cases, they're media companies, reliant on advertising, etc. So I think the whole business models will come under scrutiny, and that's a good thing. And there's going to be a lot of disruption. And so because of that, that's an area I want nothing to do with.
Next is Dr. Niall O'Connor, manager of Brooks Macdonald Defensive Capital, sharing who he wouldn't want to date.
I think I wouldn't want to date bubbles because I think they're an expensive date at the moment. There's a lot of frothiness around in the market. And 2 areas I'd highlight here. Firstly is the electric vehicle sector. That's now worth $1.2 trillion versus around $600 billion, so twice the amount of traditional car companies. And the valuation metrics are extremely stretched. We have a 23 times enterprise value to sales multiple for the electric vehicle companies, versus only 0.6 times for traditionals. So that market's looking very stretched.
Stephen Andrew, manager of M&G Episode Income, sums up a few areas he's avoiding based on investors' behavior.
So some of those areas I'd be avoiding would be, for example, just general equity in an index level sense. So just buying the index in that way and not being a bit more circumspect about it, about what the nature of that exposure is. Because you really want to try and avoid areas where there is that expressed certainty about things. These areas are the winners because they're virtual and they're not the real human contact stuff. These areas are the losers because they don't have anyone booking venues or anything like that. So you really want to try and avoid taking the market on too much with those things, but equally be very shy of participating in all that certainty. So I'd include areas of the tech area, which won't be a novelty to people. Everyone says how dear tech is, but yet still it continues to get dear. One of the primary reasons for that, of course, is it still gets good news. It's when an area stops getting good news from a fundamental driver of stuff and then starts getting bad news and the price carries on going up. That's when more of the belief about things is based upon price behavior. What can I make out of this? So I'd be sitting back, not involving in those things right now, and aware of the risk that these things do become overextended. And once they get driven by price and price expectation, that's the time to be more aggressively negative about those things.
So there you have it. Government bonds, social media, electric cars, tech, a whole range of areas to possibly reconsider for 2021. But where should you look instead? Be sure to watch our previous video on where these 6 managers are finding opportunities in the market. And remember, love is in the air, but so is COVID, so wash your hands. To learn more about any of the funds mentioned, please visit fundcaliber.com. And don't forget to subscribe for more weekly videos.